final episode of All About Debt Funds, we will shed light on innovations in the world of debt funds. Over the last 9 episodes, we've covered everything from the basics of debt funds to strategies for managing risk effectively. If you've been following up, you're now familiar with the fundamentals of debt funds. Today, we're going to take a closer look at how innovations are shaping the future of investing. These innovations allow you to be more precise in your investment approach, helping you navigate challenges and reach your financial goals with even greater confidence. Think of investing in debt funds like exploring different courses. Some courses have a fixed duration with set completion date. They are more structured, consistent, and predictable, while others offer flexible schedules allowing you to learn at your own pace and adapt the learning journey to your lifestyle. Choosing the right mix based on your goals and availability helps you progress on a timeline that truly works for you. Now, let's apply this idea to debt funds, starting with target maturity funds. These are like enrolling in a year-long degree program. The structure is well defined. There are regular classes, assignments, and exams spaced out over the course. Each component gives you consistent opportunities to earn credit and track progress. Similarly, target maturity funds follow a fixed investment horizon. They invest in bonds that mature around the same time, giving you a clear picture of your investment's timeline and expected outcomes. Just like a degree offers a predictable learning journey, target maturity funds offer clarity and relative stability if held till maturity, making them suitable for investors who value a clear path. Now let's talk about dynamic bond funds. These are more like flexible online courses. You still cover the entire curriculum, but you're free to structure your learning. On days you're busy, you can slow down, and when you have more time, you can move ahead more quickly. It's responsive to your pace and preferences. Dynamic bond fund works in much the same way. They don't stick to a fixed maturity timeline. Instead, they adjust to changing market conditions, especially shifts in the interest rates. When interest rates rise, the fund may shorten the average duration of its bond holdings to reduce risk. When rates fall, it might extend the duration to take advantage of suitable return opportunities. This ability to shift gears makes dynamic bond funds suitable for those who prefer a more adaptable approach to investing, one that responds to market movements and aims to optimize returns as conditions evolve. Innovations in risk management. Think of risk management like preparing for an important exam. You would not just rely on your course textbook. You would take support of other tools at your disposal, like previous year's questions, mock tests, etc. In a similar way, fund managers don't just rely on the bonds they invest in. To manage risk better, they use additional tools known as derivatives. Forwards, options, futures are a type of derivatives used in this strategy. This strategy, known as hedging, acts as a safety net. It helps you cushion your investment against unexpected changes in the market, offering you more stability and protection over time. Quick fact: target maturity funds are suitable for those with clear financial goals because they offer predictable returns over a set period. Dynamic bond funds, however, provide flexibility, adjusting to interest rate changes to help you navigate market shifts while managing risk. Task for viewers. For your final task, reflect on how these strategies might fit in your personal investment plan. How can a mix of structured and flexible tools help you stay consistent, adapt to change, and move confidently towards your financial goals? Write down your reflections in your debt fund diary and feel free to share them with us in the comments. I'd love to hear how you're applying these ideas to your journey. And that brings us to an end. Congratulations on completing this 10-episode journey to mastering debt funds. You've now built a strong foundation to make well-informed investment decisions. I'm genuinely proud of all that you've learned. Here's to your continued growth and success on your investment journey. Keep learning, keep planning, and keep moving forward. Just like all our viewers, if you're interested in learning the fundamentals and strategies to invest in mutual funds, be sure to follow Bajaj Finserv Mutual Fund across all social platforms. Thank you, and we'll see you again.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.